It's no secret that two of my favorite investors in the world are both Warren Buffett and Phil Town. I've learned a massive amount from both of those people, and both of those people have a strong focus when they analyze businesses on two numbers, and those numbers are return on equity and return on invested capital. Now, in this video, I want to get into some of the finer details with both of those figures, explain what they are and why they're important, and then also go right through to analyzing a particular company and showing you some of the potential pitfalls that actually Warren Buffett himself has fallen into in the past. So with that said, I do hope you enjoyed the video. If you do, please hit like and subscribe to the channel if you haven't already. But for now, let's get straight into it. Now, these two numbers, return on equity and return on invested capital, basically are two different ways of telling us a fairly similar thing. And that is basically telling us how profitable is a particular business relative to the financial resources used in that company, relative to either the equity in that company or the total capital invested in that business. So if we go first through a return on equity calculation, let's say we have a business that has $1 million in equity. Let's say it's got possibly $2 million worth of assets, $1 million worth of debt. That gives us $1 million of overall equity. And let's say that that business earns on average about $100,000 a year. Now, if we take that $100,000, we divide that by our equity of $1 million, we have a 10% return on equity. It tells us of all the money that's gone into this business, how much can the business earn on that capital? And return on invested capital has a fairly similar line of thinking, but it actually also includes that debt. It wants to look at the total capital invested in the business and how does the profitability perform relative to that amount. So let's take that same business where we have $1 million in equity and $1 million in debt. The calculation in that case would be our profitability. Let's say we've got net income still of $100,000 over a total asset base of $2 million because we've got the equity and we've got the debt. 100,000 divided by 2 million would give us a 5% return on invested capital. So in that business, with those numbers, we have a 10% return on equity and a 5% return on invested capital. So why are these numbers important? Well, to cut a long story short, generally speaking, better businesses, higher quality businesses will tend to have a higher return on equity and a higher return on invested capital. It's about as simple as that. And the reason that people are attracted to these high quality, high return on equity, high return on invested capital businesses is basically because they oftentimes have a lot of power to reinvest within the business. That's one of the things that does make these companies really, really attractive. So let's take a company that someone like Phil Town absolutely loves, and that is Chipotle Mexican Grill. Now, Chipotle Mexican Grill has consistently had a return on invested capital of somewhere around 15%. Some years it's been higher, some years it's been lower. And they've had a long runway to continue reinvesting in the business at about that same rate. So when they actually go out and spend money to open a new Chipotle Mexican Grill store, it costs them around $800,000 or so, and they can get a yield of about 15% on the first year of having that store open. And it means that they can earn really good returns for incremental capital that continues to get reinvested into the business. They can grow the pie, they can continue to become more and more profitable over time, and they're these really loved kind of compounding growth businesses that investors really like and that they can hold and expect to grow in their portfolios for a long period of time. And if you're someone like Warren Buffett who basically has the mindset of buying a business and never selling it, you're almost exclusively looking for these high return on equity, high return on invested capital businesses. The last thing that you want to do if you're Warren Buffett and you put billions of dollars into a business that you're never going to sell is to purchase into a business that has limited opportunity to reinvest its capital or that earns a low rate of return on that capital if it does try to expand the business. What you really want is an absolute compound growth machine, a business like Apple, which has earned something like 20 or 30% a year return on equity over an extended period of time and continues to redeploy cash within that business to make it even more profitable as time goes on. Now, one thing that I always like to look at with these two numbers as well is actually the relationship between the two numbers. Now, often that's a useful sort of surface level indicator basically of the amount of debt within the business. Because what you have to understand is that return on equity can actually be quite heavily influenced by the amount of debt that the company takes on. Now, if you are a business like, let's say, Chipotle, now typically Chipotle has been fairly conservative with the amount of debt they take on. Typically they've taken on basically none, although they have taken on a little bit more recently. If you're a business like Chipotle and you can earn a high return on invested capital, basically every dollar that you outlay, you can earn a good return on, whether that dollar comes from the profits of the business or whether that comes from some sort of lender because you're taking on debt. If you can earn a good return on that money, regardless of the source, you can actually have the opportunity to push up your return on equity. So let's say you've got this business that earns $100,000 a year, pure profit, you've got no debt, and you basically each year take that $100,000, reinvest it, and let's say you can get a 10% return on equity and return on invested capital. They're the same number because you've got no debt in this initial example. If you can take that $100,000 and earn, say, 10% on it, that's great. And if you can continue to do that over a long period of time, you can compound this business at 10% per year and grow the earnings power of that entity over time. And that is fantastic for shareholders. Now, what you could also do with that company is if you have this $100,000 of profit each year, you could also potentially borrow $100,000 each year and have a go at growing the business a little bit quicker, perhaps. So in the initial example, if you just continue to grow it purely out of profit, you're earning a 10% return on equity, you're earning a 10% return on invested capital. But if you go ahead and borrow some money, let's say you can now invest $200,000 and you can still earn a 10% return on that full amount. So you're earning $20,000 now extra rather than $10,000 in the first case. You now have a return on invested capital still of 10% because you're putting $200,000 to work now and you're earning $20,000. That's a 10% return on that total capital, regardless of whether it's borrowed or whether it comes from within the business. But you're now earning a 20% return on equity because you're only putting $100,000 of your own money to work and expanding the company, but you're earning $20,000 on that amount. So that's why I find it often quite useful to look at the relationship between return on equity and return on invested capital. It can be a really useful indicator of whether the business is attempting to grow a little bit faster by taking on debt, and then you can start to consider some of the potential downfalls or some of the potential positives from the business and from the management team going down that track. Now, for both Phil Town and Warren Buffett, they really like to focus strongly on the return on invested capital number. Basically, that is a hard one to fudge. If you do take on debt, that number can potentially come down if you don't earn as high a rate of return on it because you're putting more capital to work, and it's not as easy to manipulate as the return on equity number. Now, the final thing I want to talk about in this video is one of the major pitfalls that I see a lot of people making when they look at these really high quality, high return on equity, high return on invested capital type businesses. And that is basically not understanding that in order for the investor to make a good return, they have to make a good return within the business on their purchase price and not necessarily the equity value of the business. And that's basically because of this reason. When you go and purchase into one of these really high quality businesses in the stock market, you are generally paying many multiples of the book value or the equity value within that company. Now, I'll put some numbers up on the screen here with someone like, say, Chipotle, because we've been using that example in this video. Now, even though a company like Chipotle has the ability to earn a 15 or 20% return on invested capital over a long period of time, and they still have a substantial runway for growth, you are buying into the business at many multiples of book value. So in order for you to get a good return as an investor, the business again still needs to continue compounding and continuing to make a good return on the equity within the business. They also need to make a good return relative to your purchase price. And a great example again is a business like Kraft Heinz. Now, this is a company that Warren Buffett has frankly come out and said that he overpaid for. He paid too much for this business. And I'll put maybe a clip up after what I'm about to say here of Buffett actually saying it himself. But basically, Warren Buffett still says that Kraft Heinz is a really phenomenal business when you look at it at a return on equity or return on invested capital basis. They have something like about $7 billion of assets within the Kraft Heinz business, and they produce about $5 or $6 billion of net income on those assets. They have an enormous return on equity, an enormous return on invested capital. But Warren Buffett paid much more than $7 billion for that business. He in fact paid about $107 billion for that business. So although Kraft Heinz continues to generate really good returns relative to its assets on, $5 or $6 billion in profits relative to its $7 billion in tangible assets, that doesn't necessarily mean good profitability for Buffett and Berkshire Hathaway. For Buffett and Berkshire Hathaway to do well, they need Kraft Heinz to generate good returns relative to the $100 billion that they put in, which is a very, very different task from producing a good return on its asset base. So as always, no company is worth an infinite amount regardless of how high quality it is. But nonetheless, I love to look at return on equity and return on invested capital as really good indicators of business quality. And it also helps me inform how I think about the redistribution of profits within the business. Do I think the management team are better off continuing to grow the company because they can earn high returns on that money? Or do I think they are better off looking at something like a share buyback or paying a dividend? So I do hope you enjoyed that video. If you did, please hit like and hit subscribe, and I will see you in the next one. Cheers.
The interesting thing about Kraft Heinz is it's still a wonderful business in that it uses about $7 billion of tangible assets and earns $6 billion pre-tax on that. So on the assets required to run the business, $7 billion, they earn $6 billion roughly after depreciation pre-tax. But we and certain predecessors, but primarily we paid $100 billion more than the tangible assets. So for us, it has to earn on $107 billion, not just on the $7 billion that the business employs. And we don't have a way. It'd be wonderful if we had a way to deploy another $7 billion and earn $6 billion, but it isn't there.